3 stocks for October 2018, the spooky, slightly more risky Halloween edition. Let's get started. What's up everybody, my name is Ale and welcome to my world of stocks. By the way, you guys have been hitting the like button on so many of my videos. It's really been helping the channel grow and survive. I really appreciate it. In last month's video, we had almost 400 likes, which is insane. I just want to say thank you. It really means a lot to me. Now, as you guys know, every month I try to bring in 3 stocks that I think should be on your radar. And I try to mix it up a little bit. And because this one is for the month of October, kind of Halloween time, I figured that we should do some stocks that have a little bit of risk involved as well. Now, stock number 1 is actually a dividend growth stock. And if you've been keeping up with the channel, then you know that dividend growth stocks are actually my favorite to invest in. I've been building up a dividend growth portfolio basically from scratch. So this is a stock that I would like to invest in, but the thing about this one is that it's a company that operates in an industry that I'm not too familiar with and I've never actually invested in. So that does actually bring a little bit of risk as well. And stock number 2 is a stock that has been absolutely hammered recently, and a lot of people are calling it a falling knife, but I do think that there is still some potential there. And finally, we have stock number 3, and this one is the complete opposite. This is going to be a stock that has been absolutely soaring, leading to many investors calling it overvalued, but I still think that this stock is going to go even higher in the long term. Okay, now just a quick side note and a couple disclaimers. I will have timestamps in the description and as a pinned comment down below, so if you want to jump ahead to any of the 3 different stocks, you can do that. And just a quick disclaimer, like I said, all 3 of these have some risk, especially stock number 2. I mean, a lot of people really consider it a falling knife. So just be a little careful. Make sure you do your own research. Make sure you make your own decisions. I am talking about these 3 stocks long term. In the short term, anything can happen, and I really have no control over that. And then I also just want to mention that I don't have a position in stocks 1 or 2, but I do have a small position in stock number 3. In comparison to my portfolio, it's a relatively small position. And then with stocks 1 and 2, I'm still tracking them, still kind of waiting for the right moment to buy in. But those are stocks that I'm thinking about buying, but I still have not bought them yet. Okay, now stock number 1 is a little risky because it's the one that I have the least amount of experience with, and I've never really invested much in their industry either. And that industry is the health and life insurance industry. And but the more I research the stock, the more that I find that they do have some pretty good stability, and they seem to be a great dividend growth stock for the long term. And so this company is Aflac, and their ticker symbol is AFL. Okay, now you've probably heard of this company before. They're pretty famous for their advertisements. They have some very popular commercials with a duck that quacks out Aflac. But if you don't know anything about this company, their business mostly revolves around different types of health insurance, and that covers a range of different things, from hospital visits to injuries at work to life insurance and even cancer treatment, which we'll talk a little bit more about in just a second. Now, Aflac is currently trading at around $46 per share, and despite having a monstrous July up over 8%, they're only up around 6% year to date. And most of the year has actually been a little volatile. You can see that on this chart right over here. Now, the reason why they've been a little volatile is because of some fraud accusations, but to my knowledge, those never really went anywhere. And so after a very impressive last quarter, the stock has been rallying as they reported a massive 20% increase in earnings, mostly due to tax reform and their cancer insurance plan doing very well in Japan. But if you also look at their long-term performance, this isn't a company that has been returning massive gains to shareholders like some other popular stocks, but it's at least been very stable, and it's also been trending upward over time. In fact, in 2016, they climbed 16%. In 2017, they climbed 26%. And year to date, I do think that they would be much higher if it weren't for those other issues that we discussed earlier. But the great thing about Aflac isn't their stock performance. It's really the fact that they are a dividend growth stock, which really attracts an investor like me. In fact, Aflac is considered a dividend aristocrat, which means that they belong to they're a member of the S&P 500, and they've increased their dividends every single year for the past 36 years. That is an insane track record of increasing those dividend payments. And on top of that, their yield is pretty good at over 2%, but more importantly, their payout ratio, which is what I always look at, is only at 25%, which means that these dividends are not only sustainable, but with their enormous track record and their low payout ratio, these dividends are very likely to increase in the years to come. And even looking at their valuation, they have a PE of just 7.5, which is very attractive in an aging bull market where the average is at around 20 and the insurance industry is still at around 17. But having said all of that, Aflac has been a little volatile this year, so I would exercise some caution and maybe look for a nice dip or better entry point. But either way, I think long term, this is looking like a pretty stable company, very good track record of increasing their dividends, and I would honestly love to add this stock to my dividend growth portfolio. So if that's the type of investor that you are, then I think Aflac is definitely worth taking a look into. Okay, now this is the Halloween special, right? So let's just get stock number 2 out of the way. This is a stock that a lot of people are calling a falling knife, and there's very little investor confidence in this stock right now. But I would argue that while it may be a falling knife in the short term, this is a company that has a very bright future in the long term, and it's trading at very cheap prices right now. And so that company is Micron, ticker symbol MU. Now, in terms of their business, Micron is really a memory developer, manufacturer, and seller of DRAM and NAND technology products. DRAM being volatile memory, so that is memory that only saves data when it has power. So think of RAM like the RAM in your computer or your tablet or smartphone, or even integrated into your GPU. And then when looking at NAND, that is a type of flash memory that can store data even when it is turned off. So think of like a USB flash drive or something like that. Now, DRAM actually makes up the majority of the revenue at over 70%. And after having a monstrous 2016, 2017, and even rallying higher at above $60 per share this year, Micron stock is now crashing, down over 30% in just the last 3 months, and down over 20% in September alone, and is now trading at around $41 per share. That is very low. Now, the stock has been performing very poorly for a few different reasons, but one of the biggest is that memory chips are considered to be a sort of commodity, which leads to it being very cyclical. So what happens is that demand skyrockets with new technologies in a strong economy. So stocks like MU start to really soar. But if all memory chips are very similar or unspecialized like a commodity, then several companies can build them, driving up competition and, more importantly, supply. At which point brand names may not be as important as price. So this leads to more supply, which then leads to lower prices. And if prices crash, you can imagine who's going to get hurt the worst. Well, a company like Micron would certainly get hammered. But because we're in the investing world, everyone is trying to get out ahead of the downturn in memory prices and sell out of a stock like Micron that is likely to crash in the future, even though it's already crashing now because of future speculation. But something that is already worrying investors is that NAND prices are already dropping, sometimes by more than half the average price that they were trading for at last year's peak. And because NAND makes up around 25% of Micron's revenue, that ends up being a very big deal. But on the other hand, DRAM actually makes up the majority of Micron's revenue, and those prices seem to be stable at least for now. But many analysts are expecting supply to increase through the end of this year and for prices to start significantly dropping throughout next year. In fact, one analyst at BMO said the following: "Despite very favorable market conditions, the semiconductor world is very cyclical, and we believe we are in the later innings of an extended memory cycle. And unless we go into extra innings, we are reluctant to chase the stock." But with the stock's price getting so low, several other analysts feel that a lot of the negativity is already baked into the share price, leading to minimized risk with a lot of future potential from markets that we'll discuss further in just a second. In fact, according to simplywallstreet.com, MU is trading at almost half their future cash flow, and their PE ratio is 4, while the industry is at 22 and the broader market is at 20. So at first glance, this really does look like a very undervalued stock. And even looking at marketwatch.com, most analysts are bullish, with 23 rating it a buy, 2 rating it as overweight, 8 rating it as hold, and then 0 rating it as underweight or sell. And the reason why is because, again, this is a pretty cheap price for a company that has been performing very well. When looking at their income, Micron has been bringing in record-breaking profits these last few quarters. And I think their trailing 12 months, I think they brought in like over $12 billion in profit, which is just insanely high. And on top of that, their profit margin is almost at 50%, which has got to be one of the highest in the industry. And so that really means that Micron is now in a great position to pay down debt and keep investing in their costly R&D, their research and development. They've even announced a share buyback program of $10 billion, which should not only show the confidence from management, but will ultimately improve their EPS numbers going forward, not to mention the fact that they're getting these shares at really low prices right now. But again, taking a closer look at their net income on this chart right over here, you can see how volatile and, dare I say, cyclical it's been for them in the past. So for Micron to pull away from the whole cyclical nature of the industry, I really think that they're going to need to offer more customization in their products, which they are already doing. And they need to continue to offer better performance, which they claim to be doing. In fact, on Investor Day, they claim that their new GDDR6 chips have the fastest graphics bandwidth, and they also showed off other products having competitive advantages as well. But for me personally, I'm very bullish on mobile technology, artificial intelligence, the Internet of Things, cloud computing, data centers, and autonomous driving. And I think that being bullish on those markets in the long term ultimately means that you are also bullish on a company like Micron, because as those technologies become more complex, the demand for memory chips is only going to go higher as they need to store and transfer and compute large amounts of data in faster and faster times, which is very important for data centers and especially autonomous driving. Think about all the different sensors that an autonomous vehicle would have and how much data it needs to process and how quickly it needs to process it in order to maintain a safe driving experience. So Micron really stands to benefit from all of that and hopefully maybe even stabilize in the memory market thanks to that high demand. But again, many would argue that autonomous vehicles are still many years away from being in mass production. But I think that in the meantime, we still are going to have a lot of demand coming from the server market, the gaming market, artificial intelligence, and I think those will be enough to hold us over until other markets come online and drive demand up even more. So I haven't jumped into Micron yet. A lot of people are saying that it is a falling knife, and I don't think it's crazy to think that it can still drop further, but at these prices you got to figure that the bottom has to be pretty darn close. And this is a company that has a very bright future, that is a major play on all of these emerging markets out there. So I think it's definitely a stock worth keeping on your radar and possibly jumping into soon. I mean, these prices are pretty darn low. It's got to bottom out at some point, and a lot of this is based on future speculation that seems to already be baked into the share price in a lot of ways. So anyway, I think Micron is a very interesting stock, and I may open up a position soon if the stock continues to drop. All right, now for the third stock, I usually pick a very massive company, and because this is the Halloween special, we're going to be adding a little bit of risk here. We're going to look at a stock that is up an insane amount, many people calling it overvalued, thinking that it's going to correct and come right back down, at least a pretty significant amount. But I'm not one of those people. I think that this stock is going to continue to climb, and I think that this will actually be the first $2 trillion market cap company in the world, and that company is Amazon, ticker symbol AMZN. Now, the reason why I love Amazon stock and why I'm actually invested in it myself is because it has long been a growth machine, but it is now turning into also a profit machine. And when you start to mix growth with profits, you get a stock that a lot of investors are going to want to jump into and get a piece of that pie. But listen, I'm not blind. I know that this is technically a very expensive stock with a PE ratio of over 150. But when looking at growth or future growth, this is a company with a massive 37% expected earnings growth rate, according to simplywallstreet.com, and they have many different engines to help keep growing even further. When looking at Amazon's online retail, it's already very dominant, but it only makes up around 10% of global retail and even less of US retail, leaving plenty of room to grow. And they're already the world leader in the cloud computing market with Amazon Web Services, which controls around 35% of the market, and the next closest competitor is Microsoft at only 13%. And because AWS brings in over 50% of their operating income, having cloud revenue jump almost 50% last quarter with solid margins that are close to 30% means that they are absolutely killing it. This is a segment that brings in tens of billions of dollars every single year, and most analysts are predicting for that number to keep climbing at a fast rate. And if those margins are impressive, Amazon's online advertising is estimated to have margins as high as 70%, and in their last quarter, advertising revenue was up 130% year over year. Those are insane numbers. In fact, the same quarter brought in record profits for Amazon that were 10 times higher year over year. That is mind-blowing. And with relatively recent acquisitions of Twitch to compete in the gaming market, Whole Foods to compete in the grocery market, and even PillPack to compete in the online pharmacy market, Amazon isn't just waiting around for things to happen. They're dominating now, and they're looking to dominate even more in the future. And there's really no reason to think that Amazon won't be tapping into more markets along the way. So because Amazon has a history of being so dominant yet so aggressive, so much growth yet bringing in so much new profit, kind of something that we're not really used to, I think that is going to flood in even more investors, different types of investors, and I really believe Amazon will become the first $2 trillion market cap company. I really believe that. It is definitely speculation, but that is something that I believe. All right, so that's all I got for you guys today. I hope you enjoyed this. A little bit of a weird video today. I wanted to bring in some stocks that were a little questionable, some stocks that were maybe a little divisive, and I feel like Micron is definitely one of those stocks people argue a lot about. Amazon, absolutely a stock that people really argue about, value investors, growth investors, and now it's getting crazy that how profitable they're actually becoming. So anyway, I just wanted to mix it up a little bit. I hope you enjoyed it. If you did enjoy this video, make sure you let me know by hitting the like button, supporting the channel. That's a great way to support the channel, and I really appreciate it. Thank you so much for watching. Make sure to leave a comment down below if you have any suggestions, comments, anything you want me to take a look at and respond to, and I will catch you in the next video. Have a wonderful, beautiful day, and take care. Bye-bye.